morning, good afternoon, and good evening. My name is Rogelio Noriega. Thank you for joining me. It's Jedi.Tax Online. We do apologize for the late start. Won't even bother to get into any of that stuff, but want to thank you. Today is December 14, 2025. We're going to be going over some recent legislation in the financial world here in the United States of America, and I thank you for joining me. And we're just going to get to it, ladies and gentlemen, because there is a lot of stuff that we have to get to. So I believe that everything is working. Well, you know what? I don't know if it is. Let me do a quick sound check. And yes, that one is working. And yep, everything seems to be on my end. So it's all good in the hood. We're going to go ahead and begin. And let's just get it going, folks. Of course, we have to start off with the Selena rule, ladies and gentlemen. Reminder, this is, we're not giving you advice anyway whatsoever. We are giving you information. It is up to you what you want to do with it. The accuracy of the information is information contained on our website, and we make no representation along those lines. This is all the legalese stuff. You have to read it. And of course, we provide no warranty, and there is no liability on our part. This is as is, and we are just providing you the information. So it is just here. If you wish to act on any information provided, you need to consult a professional. So if you do this on your own, you're doing it on your own. So there are a lot of people out there. You can reach out to us, of course, but you know how it is. We've got to post this stuff up there. So today, of course, as I mentioned, is December 14, 2025. My name is Rogelio D. Noriega. I have 38 years of tax preparation and financial experience. I am registered through California, also the IRS, and I'm an Internal Revenue Service certified acceptance agent. And Jedi.Tax is a multi-state, multinational small business helping people. So we have locations, or I should say preparers, in New York, Texas, Arizona, and California. We're proud of that. And of course, in Mexico as well. You can reach us through our website, but that's who I am. That's what I am. We'll get to it. That is our website. Duh. Jedi.Tax. And of course, for most of the tax year that we're currently in ends at midnight on December 31st of this year. You need to make corrections or adjustments before the year ends. Now, do I have good news? Do I have bad news? The answer is yes. We'll start with the good news. Some changes about the One Big Beautiful Bill, as it's been called, are effective this year, and I'm going to get into that a little bit later. Others don't come into play until 2026, impacting returns filed in early 2027. It is a tax cut. Maybe. It may not do anything for you. It depends on how much you earn. There is no additional monies in this. This is not the COVID monies where all you have to do is file and there's going to be money there. No, there is nothing like that. So understand, it's a tax cut. It is not a stimulus plan, anything like that. The bad news. Well, we'll talk about a little bit of that. How much will this cost us? This is not free. Obviously, the CBO already projects that this law will increase federal deficits by approximately $4.1 trillion over the next decade. This includes about $700 billion in added interest costs on federal debt. So if you think about it, 4.1 divided by 10, that means it's $410 billion approximately over the next decade. And that $410 billion being added to the yearly budget over the next 10 years will create another $700 billion in added interest. That's what it means. So folks, there's two deficits. There's the budget deficit, which is a yearly one, which we've been running since, I believe, in a deficit since 2000. And then there's the total debt. So there's numbers that you need to know. So the Trump tax bill. There are 7 tax brackets, and now the tax cuts that were lowered previously are permanent. For now, they are permanent, but again, congressional action, but they are permanent. The standard deduction will remain nearly double. As you know, in 2017, the personal exemption was removed and the standard deduction was doubled. So they're going to remain as such, and they're going to be adjusted for inflation moving forward. So in a few months, when you have to file your taxes here in the United States, and for those that have to file their taxes in the United States that are not permanent residents or citizens, which I do have clients that are in that category, it will be adjusted for inflation. And if you're single, it's $15,750 and $31,000 for couples filing jointly. The state and local tax deduction, what many people in my industry refer to as SALT, state and local tax, SALT, was limited to $10,000 on your federal return. Had nothing to do with any state returns, but in your federal, it was limited. And this is within the itemized deduction portion of the federal return, otherwise known as Schedule A, or as some people would say, the long form. Well, long form doesn't really exist anymore. It's just a form, and you can attach any schedule to it. In my world, we still have remnants of that, where we call it a simple return. And a simple return means you don't have to do any of the extra stuff, which was the long form. But anyway, the SALT is increased to $40,000, which will be a benefit for quite a few people, especially in high tax states such as California and New York. Now, employees in traditionally tipped jobs can include up to $25,000 in tips from federal income tax through 2028, subject to income limits and phase outs. We'll get to that a little bit later. This is a summary. Overtime pay up to $12,500 or $25,500 for joint filers can be deducted in the same period, subject to income limits and phase outs. I believe one of the phase outs is $500,000, but don't quote me on that. We'll get to that later. The federal child tax credit of $2,200 per child remains, but now requires a valid Social Security number. If you were filing a tax return, an ITIN was cool. It's not anymore. You're going to need a valid Social Security number. New child savings accounts called Trump accounts start with a $1,000 federal deposit for kids born in 2025 through 2028 and allow further yearly contributions, again, subject to limits and rules. There's an increased estate tax exemption, raising the threshold to $15 million beginning in 2026 and will be indexed to inflation moving forward. I believe the last number that I remember was $13 million, but it's now $15 million and it's going to move up. Due to this new tax bill, Medicaid and SNAP funding takes significant hits, and this will result in reduced eligibility or enrollment, increased work requirements, and lower funding levels. It is expected that millions will lose healthcare coverage or food assistance because of the program cuts. And when you look at what Congress was fighting about, the extension of the ACA credits, this is a significant blow to many families. These are working families. So, extended TCJ provisions. As I mentioned, the individual income tax rates were set to expire at the end of the year. They've now been extended, as you see that. The standard deduction nearly doubled under the 27 Tax Cuts and Jobs Act, and it will maintain the nearly double base standard deduction from the prior law and indexed annually for inflation. Personal exemptions, as I mentioned, they were repealed under the Tax Cut and Jobs Act. They're gone. The personal exemptions, but there's a deduction for a dependent That one remained. But that's what we'll get into a little bit later. Estate tax exemption increase. As I mentioned, the lifetime estate and gift tax exemption was scheduled to be reduced by half in 2026 due to looming tax cuts and Jobs Act expirations, the TCJA. However, under the 2025 tax bill, the lifetime estate and gift exemption increases as of January 1st, 2026 to 15 million and now 30 million for married couples. Wow, that is significant. Meanwhile, gifts given before 2026 benefit from the already high 2017. Meanwhile, gifts given before the 2026 benefit from the already high 2017 tax exemption. So it's going to benefit you no matter what. As I mentioned, the state and local tax deduction cap change went from 10,000 to 40,000, but that is only from 2025 through 2029. That one is not permanent. So we're going to have to pay attention. There's going to be another fight in 2028, 2029, 2030 for this. But as I mentioned, as a result, taxpayers who itemize deductions can deduct a large amount of state and local taxes, including income, sales, and property taxes from their federal taxable income. This cap increases by 1% annually during this period, but phases out for taxpayers. And now MAGI, which is modified adjusted gross income. I'm not going to get into that. You know or you don't. Exceeding 500,000, returning fully to 10,000 for all taxpayers starting in 2030. So this is a temporary change. This is what bugs me, especially in the Democratic Republican arguments. All business cuts are permanent. The personal ones, there has to be a fight for them. Who defends business? Who defends families? Figure it out. So, the old cap deduction within the Schedule A was 10,000. It's now 40. Effective year 2018 through 2024. That's when it was reduced. It is now through 2025, 2029. Income threshold for full limit, nothing. This year or moving forward, it will be 500,000 modified AGI. The modified AGI has to do with, look, you're not going to take your regular earnings and regular deductions. Under tax law, you have to modify it if you have excessive deductions. And again, if you know, you know. So if you're under the modified AGI, there's some creativity to your finances. Was there a phase out? No. Gradual reduction above $500,000 modified adjusted gross income. Revision year? Well, no. In 2030, the cap reverts to 10,000 again. These are generally homeowners, but they're also high income earners that have a lot of state withholding. New tax deductions. That's what you get when you do it at 9:30 at night. Car loan interest deduction. I can't believe I missed that one. And I read everyone all over again. Taxpayers may deduct interest on car loans up to $10,000 per year for new qualifying vehicles assembled in the U.S. I have no problem with that. Purchased after December 31st, 2024. So we're already in it. That's what I mentioned early on in this program. Some of this stuff is in effect now. So when you prepare your taxes in a few months, you're already going to get a benefit. This is one of them. So eligible buyers may be able to reduce their overall tax liability without itemizing deductions. When I say itemizing deductions, that's when I was talking about that simple and long form type stuff. Generally, homeowners who have a lot of deductions, state and local taxes, property taxes, medical expenses, charitable contributions, mortgage. Well, you don't have to worry about that. You're still going to be able to deduct interest up to $10,000 per year. Now, it's not your car payment. It's the interest that you pay yearly. Can't accelerate it either. That's a business expense, but we'll get into that. No, not today. Talk to your professional. The tax break applies to passenger cars, light trucks, SUVs, and motorcycles used for personal purposes. So I said, if it's a business, something else. Deduction phases out 20% annually. Oh my God, this is back like in 1987 and 88, the first year I was doing taxes. There's a phase out. So it starts with 100,000 modified adjusted gross income for single filers and 200,000 MAGI for joint filers, with full phase out at 150 and 250,000 respectively. Jeez. Vehicle identification or VINs are going to be required on the returns. This deduction expires December 31st, 2028. So you see, again, it's a personal one, not a business one. There is a sunset on this one. That really sucks. So you're going to get it for the year that we're in now, 2025, 2026, 2027, and 2028. 4 years. That's it. Unless it's extended. No tax on tips deduction. Employees in traditional tipping occupations. Now, the IRS already issued who qualifies and who doesn't. Speak to your professional, such as servers, bartenders, salon workers, may exclude up to $25,000 in tips earned from federal income tax for tax years 2025, 2028. Again, even though you're working, this is a personal, it's not a business. It's a personal thing, and there's a window, a sunset on it. That's the cold part of it. That, if you're going to do this, do it, but you really screw the average person by this, because you can't allow them to plan moving forward. It really sucks. But this essentially means eligible tipped workers might keep more of their earnings, by paying less than federal income taxes on tips they earn through 2028. But the income phase outs start at $150,000 single and $300,000 joint. There are limitations. Speak to your professional. Self-employed individuals in tax trades are included. We'll see about that. The line must be drawn here. Payroll and state taxes still apply to tips. So it is what it is. This has nothing to do with the fact that Jedi.Tax will be a corporation in January. No. Let's just say we're using tax law. Overtime pay tax deduction. A deduction for overtime pay of up to $12,500 for a single and $25,000 for joint is allowed from 2025, which is right now, to 2028, subject to the same income phase outs as a deduction for qualified tip income. So these are for people who earn tips, and they earn basically, as I mentioned, let's go back, less than $150,000, and if there's a married or joint tax return, $300,000. Child tax credit under the Trump tax law. The child tax credit maximum is $2,200 per qualifying child, and that will now be indexed to inflation starting in 2026. The refundable portion of the credit is still capped at $1,700 per child. So many know that if you earn less than, say, $30,000, you have a whole bunch of kids, your refund, in addition to the earned income credit, can be significant, because once you no longer have tax, because the child tax credit is able to wipe away a lot of it, if you have any of that credit left over, $1,700 per child is refundable. That can be a lot of money for working families. And it is a good tax credit because they have children, and children, opinion here, should not live in poverty. And a child tax credit puts real money into pockets of working families. Valid Social Security numbers that is my opinion. Valid Social Security numbers are required for taxpayers and dependents to claim the credit. Prior to this new law, if you had an ITIN, you could claim the credit to reduce your taxes. That is now gone. So The credit amount per child, which was in effect now, was $2,000. So, and it's going to remain $2,000 in January of next year. But in the 2026 year, it's going to go up to $2,200. So a year from now, in April of 2027, you're going to get the $2,200. The refundable portion under the prior law was up to $1,700. It is capped. Even if the deduction goes up every year, it is still capped at $1,700. The phase-out thresholds, this is what I mentioned for working families. $200,000 for singles, $400,000 for joint. Same phase-outs under the new law. And the Social Security number requirement, child must have an SSN parent. Filing can use an ITIN. I'm sorry, child must have an SSN. Parent filing can use an ITIN. That's gone. Taxpayers and dependents each must have valid SSNs. Wow. That's today's political climate. They're still paying taxes. Now, this is huge. This is a mean change in the law. I'm not talking about, it's a mean change. Because if you have an ITIN, folks, you're filing taxes. So to have this credit taken from you, yeah, that's again. All right. The Trump account for kids. New tax-exempt Trump accounts receive. Okay, let me go back. This is going to put a lot of people that are going to, the Social Security number requirement is going to, it's going to shrink the budget even more, because people who file with ITINs, and I know there's a lot of anger and stuff out there, but I've been doing this for 38 years, folks. I will tell you that people that file with ITINs pay taxes, and they do readily, because that's the law. They're supposed to file. And some of them do have families, and all it does is reduce their taxes. They still have to pay for the most part. Almost every ITIN client that I have has to pay. So losing that deduction, it's rough, but it's my opinion, and we'll let it go at that. The Trump account for kids, this is the savings ones. The new tax-exempt Trump accounts receive a government-seeded $1,000 for children born between 2025 and 2028, with additional non-deductible contributions capped at $5,000 per year. Again, it's directed at families, so you know who voted for this. It ends after the 2028 year. Come on, man. This is, I'm actually okay with this. Is a good idea that we're starting a family and the child will start with $1,000. And these funds after 18 can be used for education, home purchase, or retirement purposes. This is a good idea. There's a lot of other good ideas in this tax plan. I'm not going to get into them, but this is a great idea. But it's only going to be from 2025 now, 2026, 27, 2028. There's a senior bonus deduction. I don't qualify for that. I'm still off by 9 years. Taxpayers over age 60. A lot of people think that I've retired now, and everyone who knows, all I did was trade a 12-month job for a 2.5-month job. Yes, I retired from my regular job. I'm done. I have an incredible amount of freedom now. I worked for 2.5 months. I'm retired. I did it. Taxpayers over age 65 receive a bonus $6,000 deduction through 2028, starting for incomes above $75,000 single and $150,000 joint. I don't think I have very many clients that are in that range that are retired with those numbers, but I have quite a few in the earning, but retirees in that, no. But it doesn't matter. It's there. The deduction is available for eligible taxpayers, whether you itemize or take the standard deduction, which is good. Other key tax changes. Remember the 1099K threshold? Zelle, and all these others, Venmo, Cash App, they was going to be reduced, remember, to like $600. Well, the reporting threshold brings the higher amounts back. So the GOP tax and spending bill brings back higher thresholds for 1099K reporting. A lot of people who work in the e-business, such as Uber and Lyft drivers, delivery service workers, stuff like that, you know, usually if you get $20,000 in earnings, you got a 1099K. Anything above that or anything below that, you really didn't get one. But you would get them from PayPal, Venmo, Cash App, Etsy, StubHub, eBay, and Airbnb. I mentioned Zelle. Zelle is a genuine peer-to-peer. It is exempt. It was exempt. It is exempt. And it will be exempt from any 1099K reporting. Because there are no fees, no nothing. It's a person-to-person. Everything else, it's a business one. Talk to your representative. So for payments you receive for 2025 sent to you in early 2026, you will only receive a Form 1099K if you receive more than $20,000 in gross payments and you conduct more than 200 transactions on a single platform within a year. So if you receive $19,000 in 199 payments, nothing. HSAs, a little bit of change here. The 2025 tax law expands eligibility by allowing individuals enrolled in the Bronze or Catastrophic Affordable Care Act plans to contribute starting in 2026. The Affordable Care Act has different levels of coverage. That's what this is referring to. And now, if you're in those, you can contribute to an HSA. It also permanently allows telehealth services and direct primary care fees to qualify as an HSA expense, broadening the types of healthcare costs that HSAs can cover. HSAs are good. They are. You can put money in there. You don't have to use it every year, but you use it for expenses. And if you use it, there's no tax transactions if they're used for eligible HSA expenses. What it means for most: they largely retain their prior features, including triple tax advantages on contributions, growth, and qualified withdrawals. So we look at the feature up at the top right here, pre-2025 and new rules starting in 2026. Eligibility: only high deductible health plans, excludes ACA bronze or catastrophic plans. Now, the Affordable Care Act bronze and catastrophic plans are eligible for the high deductible. They're deductible as eligible high deductible health plans. So, qualified expenses include typical items such as telehealth fees and direct primary care fees were, right? They were. Oh no, they excluded. So in other words, if you had an appointment with your doctor telehealth, you had paid for the appointment, it's a doctor appointment. Nope. It was a telehealth appointment, not deductible. Now it is. It did not include Medicare expenses. Medicare enrollees still are not eligible for HSAs. Keep that in mind. Tax benefits: triple tax advantage, contribution growth, and withdrawal, and the triple tax advantage remains the same. So there are subtle ones. The reality is that there are I have clients that visit with me because they don't have access to a computer or a monitor or a camera, and they visit with me and they conduct their appointments here in my office, or I set up the appointment for them. You can have it on your phone, you can have it on your computer at home. Not everyone has a camera. So I've offered that service as well. I set up retirement appointments, all sorts of appointments. I've opened up my office to that, and it works. So student loan changes under Trump. Though not tax related, the Trump tax and spending bill also introduces a significant overhaul of federal student loan programs. Popular income-driven repayment plans initiated under the Biden administration will be phased out. Borrowing for graduate students and parents will be restricted, and some options for deferment due to economic hardship or unemployment will be eliminated. There's going to be a lot more in this. I may do one on this in the future. I don't know. I'm going to have to. The changes are significant. Though recent news reports indicate that the Trump administration might follow through with processing student loan forgiveness under certain Biden-era programs, I have to verify that comment right there, because I believe there were several actions that happened within the last week or 2 weeks of today, December 14, 2025, where the Trump administration sued and they won. So the program is being unwound. It's being ended. So we have to be specific on what we're talking about, whether they're going to follow through with the processing. Some programs are ending effectively. If you're in it, there's a complexity. So I'm going to have to do a program on this. Yeah. But the Trump administration did score a legal victory, ending the Biden administration repayment plans. And of course, there's more. While the pandemic era American Rescue Plan, ARPA, excluded forgiven student loan amounts from federal taxable income through 2025, the Trump GOP tax and spending bill doesn't extend that exclusion. That means unless Congress acts, student loan debt forgiven after December 31st, that's what I was talking about, whether it was still in effect, will once again be considered taxable income at the federal level. So, for those of you that received 1099-Cs, cancellation of debt, this is akin to this. In the mind of the IRS, if you owe a credit card debt, car loan, or whatever, and you don't pay it, well, you are contractually liable to pay it. Well, you're freed from it now because you're not paying it. Well, you get a 1099-C. The IRS says, that's income now because you had committed to that contract and you're not paying it anymore. Guess what? That's income you got to pay. So that is what I'm talking about. That means unless Congress acts, student loan debt forgiven after December 31st will once again be considered taxable income at the federal level. That could leave borrowers who are counting on PSLF or other forgiveness programs facing an unexpected tax bill. And I do not have the initials for PSLF. Should I look that up right now? Yeah, I guess I will. That is PSLF. Look, that's only my second one in this entire program. Federal student. Oh, the public service loan forgiveness under the Biden administration. Sorry. So, yeah, I'm going to have to do a program on that as well. Do you know this is about as political as it gets? The new tax law delivers a major shakeup to federal clean energy initiatives setting expiration dates for popular tax programs. Homeowners planning to install rooftop solar or battery storage have until December 31st of this year to qualify for the 30% residential solar tax credit. After that, the credit will disappear. See you, muchachos. Electric vehicle buyers face an even tighter window. The federal EV tax credit for new, used, and commercial clean vehicles ended for vehicles acquired and put into service after September 30th. That's done. It has ended. It is expired. So if you buy an electric vehicle, no more $7,000 program for you. Now, if states have that program, those may still be in effect. So again, you have to speak to your tax professional in your state to find those details. So the credit for installing home EV chargers does remain in effect for a period of time, expiring for equipment placed in service after June 30th of 2026. So that is next year. With these deadlines, some analysts say the law is expected to slow the momentum of clean energy adoption. Oh, duh! and raise the cost barrier for solar and EV upgrades. Yeah. Now, that was a lot of personal stuff. Now we're going to get into the business provisions, and I'm going to be able to fly faster through this. The Trump GOP tax and spending bill impacts businesses as well. The permanent 20% small business action for pass-through entities like partnerships and sole proprietorships remains. The permanent 100% bonus depreciation and full expensing for business investments remains. A permanent lower corporate tax rate, initially set by the 2017 TCJA, remains. I believe corporations were reduced to 21%. Other key business provisions are summarized in the following table. There it is. Bonus depreciation. Permanent 100% bonus depreciation on qualified property placed in service after 1/19/2025. It will remain effective January 20th, 2025. Qualified business income deduction section, the 199A, is made permanent with increased deduction rate to 23%. And modifies phase-in thresholds, effective as of the tax year 2025, which we're in now. See what I mean about the benefits to business? They get them now, and they're permanent. It's crazy. But personal stuff, they have a sunset. That is not cool tax policy. That's vindictive. And that's what we get in our politics today, folks. Qualified small business stocks gains, increase income exclusion limits, and phase in for gains exclusion based on the holding period and asset thresholds. It's effective from 2025 onward. Healthcare and food benefit cuts. It's part of the act. We're going over it. Medicaid cuts and rule changes. The bill enacts the most sweeping cuts to Medicaid since the program's 1965 inception. And a lot of people that voted for the people that enacted these changes are learning the hard way. They're screwed. This is how vindictive this bill is. People don't know it. They followed and supported it, and now they're going to be losing benefits as well. The Great Society has a significant chip in that bowl or dome. Great Society. The legislation reduces Medicaid funding by roughly 18% over a decade, about 600 to 800 billion, according to the CBO, though a combination of eligibility restrictions, asset tests, and work requirements. So we're going to see how it's going to impact people with disabilities and live in rural areas. It's going to be bad for a lot of people. Appalachia. I'm not laughing at them. I'm laughing at the sadness of this bill. It's vindictive. Most adults, including parents of children age 14 and older, will need to work at least 80 hours a month to keep coverage. There are some exceptions. That's harsh. But it depends what you feel. I'm not telling you it's a good or bad change. I'm just telling you the reality. So states will be required to reassess eligibility every 6 months rather than annually. Now, for those of you that were live during the great welfare change in the 1990s, there were significant changes that were done, and it benefited a lot of people. But some states chose not to play along, and we're going to see if that's going to happen again. So a lot of this money will be transferred to states. We'll see. As I mentioned, states will be required to reassess eligibility every 6 months rather than annually. Okay, more paperwork. States could also impose copays up to 5% on household income and require monthly income verification. As I mentioned, the Great Welfare Act didn't have some of that stuff. Well, it actually did, but some states chose to ignore it because they were going to pay for it. Well, this law requires it, so we'll see. Otherwise, the states are going to pay. California has Medi-Cal, their own version of Medicaid. States, the CBO estimates that 10 million to 12 million people could lose Medicaid coverage over the next 10 years, with additional losses expected from tighter Affordable Care Act limits. I do know several people today that are working, have decent jobs, but they have Medicaid or Medi-Cal. They're working. They cannot afford health insurance plans. I don't know if they're going to lose their coverage. They're already working, but it's how much money is going to be out there. So it's going to be hard for a lot of people, and it's going to get worse as we move forward. The impact is expected to fall hardest on families with lower incomes, people with disabilities, and rural residents. Now, SNAP, this is Supplemental Nutrition Aid Program. Oh, there it is. Now, the SNAP program funding, formerly known as food stamps, will be cut by about 20%, an estimated $230 billion over 10 years. Work requirements are expanded to cover adults up to age 64, up from 50, and parents with children under age 14 and older. Wow. So if you have a child that's under 14 and older, you're going to have greater work requirements. States will be required to shoulder a greater share of SNAP costs or risk losing federal support entirely. Well, some states don't even offer this, so go figure. Many family advocates say these changes threaten to push millions into food insecurity, especially older workers of families in high unemployment areas. Yes. So here's the program: spending reduction, key changes, effects, and projected impact. Medicaid, $863 billion reduction. New work and reporting requirements, eligibility restrictions, cost sharing increases, immigrant coverage changes, and lower reimbursement rates. Now, understand, if you did not have documentation, you could not receive this, no matter what anyone in Congress says. Politicians, the law is the law. You had to be here legally. So this whole thing that you're giving benefits to illegals is false. But the line immigrant coverage refers to residents and non-residents and people who just work here. So you have to look into the law. But anyone who screams saying that people who are here illegal are receiving these benefits, that's wrong. Because you have to prove that you have a legal Social Security number, not an ITIN. An estimated 10.9 million people losing coverage, with a disproportionate impact on rural and vulnerable populations. Yes, many people that supported this party are losing benefits now. Go figure. SNAP, a $295 billion cut. It's cuts to administrative funds, tighten eligibility, new state cost sharing based on payment error rates, and reduced benefit growth tied to thrifty food plan costs. So the reduced food assistance for low-income families, able-bodied veterans aged 18 to 64 lose their previous work exemption, risking food aid loss for about 1.2 million veterans. Yep. We're going to cut $300 billion. This is how we're going to do it. And who's going to benefit? You're not balancing the budget. You're just paying for greater tax cuts for other people. So 1.2 million veterans are at risk. More changes are coming in 2026. Starting in 2026, the new law limits gamblers to deducting only 90% of their losses. Because the reality is, if you're a gambler and you win, and I've had this, I've seen it, I've seen the reports, where if you win $100,000, they present the player card report from the casino or casinos. They have expenses in excess of $100,000. So if you had any gambling winnings, you could deduct all of it and you wouldn't pay on any of it. Well, now the government says, nah, you can only deduct 90%. Wow, that's crazy. This change will apply to all gamblers and related gambling expenses. However, as Kiplinger, who I rely on, has reported, several bills have been introduced proposing to reverse this, so stay tuned. It means that if you win, you're going to have to pay something, whether you had losses or not. Wow. So there it is, gambling loss deduction up to 100% of losses, now only 90% beginning in January. So this will not take effect until January 2027. But, when you report it and you settle up. But as of January 1st, 2026, if you win $10, you are going to have to pay taxes on one. Okay? That's the best way I can say it. No, man, I don't want to do that. But yes, it is the way it is. The tax effect, break even, no taxable income, losses fully offset wins. Now taxable income on 10% of losses. Even if break even, a lot of people are going to suffer. But 10%. Charitable donation tax deduction. Now there are significant changes. Okay. Starting in 2026, so in January, you can start planning. Individuals who claim the standard deduction, in other words, don't take their personal exemptions. I'm sorry, you don't consider your state and local taxes, mortgage, real estate, all that stuff, will be able to deduct $1,000 annually for single filers and $2,000 for joint filers. Now, there was a deduction like that during COVID, so it's going to be in there, but it has to be to qualified charitable organizations. It can't be to someone on the street. It has to be a qualified charitable organization. They're going to have to provide you a receipt. Previously, only those who itemize deductions could benefit from the charitable donation tax. Additionally, for high-income taxpayers in the 37% tax bracket, the value of charitable deductions has been capped at 35%, meaning they can receive a maximum of 35 cents in tax savings for every $1 donated. Wow. And that will start in 2026. So, charitable deduction for non-itemizers, not allowed. Now it is a $1,000 for single and $2,000. Charitable deduction floor for itemizers. There was no floor on deductible gifts. Now it has to. Oh, you rat. Must exceed 0.5% of adjusted gross income to be deductible. Man, this is like the medical one where you have to have 7.5% of your adjusted gross income to begin to deduct. So once you get to do the long form and you itemize, if you have $10,000 in medical expenses, but you have $50,000 in adjusted gross income, again, if you know, you know, $375. Wait a minute, that's not right. 500,000, 50,000 times 0.075. $3,750 was what you had to jump over of that 10,000. So you can only deduct of that 37. I'm sorry, the minimum is 3,750. You had 10,000. You can only deduct 6,250. Isn't that crazy? That's on the medical. So that's what this is. 0.5% of adjusted gross income. So if you're at $50,000 times 0.05, it's not right. 50,000 times 0.05. $250. Man, they really go after personal people, don't they? But business, oh no, they're covered. The cap on deduction value for high income taxpayers 37%, full value at 37. Now it's cut at 35 for those at the 37% tax level. Donations to donor advised funds and private foundations, fully deductible if itemizing, and now excluded from the new itemizer deduction. Now, donor advised funds and private foundations are now excluded. Private foundations sounds like schools, hospitals, universities. They're now excluded from the non-itemizer deduction. But if you still itemize, you could deduct them. Wow. Yeah. So if someone earns $10,000 and they give $1,000 on their tax return, I know I'm ridiculously playing with the numbers. You cannot, of that $1,000, give it to a private foundation. unless you do the long form. So, whoops. The ACA tax credit expiration. That's what was going to happen on December 31st. So, unless Congress acts, the premium tax credit subsidies for the Affordable Care Act marketplace will expire after December 31st, 2025. People are already receiving quotes now, and the numbers are horrific. Congress originally extended these premium tax credits during the pandemic in 2021 and later extended them through the end of 2025. They substantially lower health insurance costs for more than 24 million people in the US, or roughly 7% of the population. Data shows tax credits have helped make coverage affordable for a range of people, including self-employed, small business owners, and those who lack access to employer or other coverage. As Kiplinger has reported, whether the credits will be extended is at the heart of the current government shutdown battle. Well, what happened was none of that was extended. We are going to see more and more people without insurance coverage. Now, in California, I'm not going to get into Massachusetts right now because I only have one client in Massachusetts. And they have coverage to their employers, so they're actually okay. But in California, there's a requirement for everyone to have medical coverage. There's a penalty in California, and it's a sizable penalty. I've seen it up to $1,200 per year for not having medical coverage. That's going to be bad. So this stuff will not happen until the 2027 year when you have to settle up. But a lot of people are going to lose coverage because it's just way too expensive, and they're just going to accept the penalty. Now, of course, if you earn a certain amount and you have all these different situations, you can avoid the penalty in California, which are the old federal exemptions. Yeah. That's what I'm talking about. This being a mean and vindictive bill, folks. These aren't people over here that are not doing anything. These are people that are working, and insurance coverage is expensive. Now, if these people lose coverage in everywhere, your medical bills are going to go up because remember, if they don't have medical coverage and there are laws that you have to pay for emergency coverage, who's going to pay for that? Everyone else who has coverage. The deficit and impact of this. Proponents argue the bill's tax cuts and spending changes will boost growth and jobs. I'm sorry, folks. That is a lie. Trickle-down economics does not work. First year was done, 1981. Doesn't work. A tax cut does not translate into boosting the economy in such a way that the tax cut pays for itself. It never has. It never will. We've learned that. That is a lie. Anyone who says that it will, you're lying. Prove it. They don't. They can't. They won't. But the numbers tell a more complicated story. The CBO projects the bill will add about $3.3 trillion to the national debt over 10 years, even after accounting for the spending reductions and new revenue measures. The reality is the reality. Remember I mentioned earlier I was going to add $4.1 trillion to the debt, which included approximately $700 to $800 billion in interest costs alone. So that's where the 4.1 trillion came in. 800 billion in interest, plus everything else, plus the 3.3 trillion in national debt. That's where you get the 4.1. Other independent estimates, which factor in the interest and the additional debt, put the truer cost closer to 4.5 trillion or more over the decade. We're adding to our national debt. Our nation is a debtor country. The survival of our nation is at stake. Who benefits? A tax foundation analysis shows the largest tax cuts will go to households earning above $400,000. The top 100% would receive a disproportionate share of benefits compared with those making under $100,000. Look at the law, look at where the deductions are. It's simple. That's where it is. Data show the most tax benefits will go to the wealthier taxpayers, with the top 10% receiving approximately 80% of the total tax breaks. Look, I am far from wealthy. I am a working class Joe, but I know tax law. I know where it benefits me. And since I left my regular job and now I'm doing this, I'm going to use tax law to my benefit. And I will not benefit in any way of that. But a lot of these tax cuts for business are going to benefit me. Just is. And let me give you an example. I donate to whoever I donate. Okay. But I don't donate in my business name. Well, I'm going to have an LLC, which allows me to donate in my business name. I can do that. And I'm going to continue to do that. I'm probably going to have no personal donations. I'm going to do it through the business. That's a clear benefit to me. That's just one tiny little thing. I'm not going to, give up the house right now or whatever, but you have to speak to your financial planner, your tax advisor. But the reality is businesses, and America was built by small businesses. So the code treats businesses well. So what do you have? Good businesses or, good families? Well, you have to have a balance. But you have to have a good tax schedule that benefits everyone. And you gotta stop spending. So a lot of this will stop spending. But guess what? They stopped spending, but gave out tax breaks that are going to benefit the uber wealthy. I do not fit there, but a lot of the business tax codes benefit me and I'm going to use them. But the reality is the reality. Meanwhile, lower income Americans generally see fewer gains. Are they going to see some? Of course they are. Or even lose resources. I've talked about that through Medicaid and SNAP. Middle income families are expected to experience mixed results depending on their individual circumstances. When the first 2017 act went in under the first administration, a lot of my clients saw tax increases. It's going to happen again. We'll see. So we've arrived at did I get to the final one? Yeah, I'm done. So, almost at the hour. Selena rule. We're having a conversation. Get your own advice. See your own financial planner. You have to verify this information yourself. There's no warranty implied or expressed. You gotta check it out on yourself, on your own. I am providing information. That's it. There's no contract between us. Ya estuvo, as they say. There's nothing. But I want to thank you for your time. It is a privilege and a thrill to be able to provide this information, but it is there for you. And there's some stuff that you need to look up and verify. So I threw the little pie out there. But you got to go and get it. So thank you. We'll see you guys on the other side. Website is Jedi.Tax. See you guys. Godspeed.